All right, let's dive into one of the most important concepts in market analysis, and that's the relationship between price and volume. If you really want to understand the story a market is telling, just looking at price is kind of like watching a movie on mute. You see the action, sure, but you're missing the emotion, the drama, the whole point, really.
So, have you ever been in this situation? You're watching a stock, it's just soaring, everything looks absolutely perfect, and then boom, out of nowhere, it just completely runs out of gas and reverses. It's incredibly frustrating, right? Well, the answer is almost always hiding in what the price chart isn't showing you.
Okay, here's the big idea, the key to the whole thing. Think of the price as the event. It's the cricket match happening on the field. But the volume, now that's the participation. It's the players, it's the sponsors, and, most importantly, it's the crowd. I mean, a big match in a totally empty stadium feels completely different than one with thousands of screaming fans, doesn't it? The crowd tells you how much conviction is actually behind the game.
So let's start at the beginning, with the growth phase of a trend. This is where the big rallies are born and built. But here's the thing, not all uptrends are the same. By watching that crowd, by watching the volume, we can figure out if a trend is actually strong and has legs, or if it's just built on nothing but hopes and prayers.
This right here, this is the gold standard. It's the absolute ideal scenario you want to see. In a truly healthy uptrend, the price is rising, and guess what? The volume is rising right along with it. It's like the market is in perfect harmony. The action and the crowd's excitement are totally in sync.
And that's the key word right there, confirmed. The rising volume confirms that the price move is legit. It tells us that real money, and I mean big money from institutions, is pouring in. The buying is aggressive, and more people are showing up to join the party. This is what creates those powerful, long-lasting trends.
Honestly, this is the perfect way to picture it. A healthy trend, it starts small, right? Like a local street cricket match. But as the price gets more attention and starts moving higher, it attracts more and more players and a much bigger audience. The volume just swells, and before you know it, it's grown into a massive tournament. The growing crowd proves that the match actually matters.
Okay, but now let's look at the first sign of trouble. This is where things get tricky. The price is still climbing, maybe even making new highs, but the volume, the crowd, is starting to shrink. The match is still going, but people are starting to leave the stadium. And this is a huge flashing red light. It's a warning sign that the trend is getting exhausted. The price isn't rising because of new, enthusiastic buying anymore. It's just kind of coasting on fumes, on momentum. The music at the party is still playing, but all the important guests are quietly slipping out the back door.
That's a great question, though. I mean, why? Why do buyers start to lose interest even when the price is technically still going up? Well, the answer comes down to a really simple fundamental weakness.
It's called buyer's weakness, and it's really just about having limited money. Let's make it super simple. When vegetables are cheap, you might buy what, 5 kilograms? But if that price suddenly triples, you're probably only going to buy 1 kilogram, right? You just can't afford the same amount. Well, the exact same logic works in the market. As a stock gets more and more expensive, buyers eventually run out of firepower to keep pushing it higher with the same force.
Okay, so we've talked about the growth phase. Now for the decline, because what goes up must eventually come down. But just like with uptrends, we can analyze the health and conviction of a downtrend by, you guessed it, watching the crowd.
Now, the word healthy might sound a little strange when we're talking about prices falling, but stick with me. In this context, healthy just means the downtrend is strong, it's confirmed, and it has real force behind it. This is what happens when the price is dropping and the selling volume is actually increasing. So this isn't some slow, lazy drift downwards. Oh no, this is a confirmed move driven by aggressive, sometimes even panicked selling. That high volume is telling us that a lot of people are scrambling for the exits all at the same time. The selling is intense. Think about the last time you saw a truly awful movie. The kind where at the intermission, people don't just trickle out one by one, they leave in a huge wave, a mass exodus. That huge rush for the door, that's high-volume selling. It confirms for everybody left in the theater that, yeah, this movie is a total flop. And finally, we get to the last phase of the decline. This is when the price is still sort of drifting lower, but the volume has just completely vanished. The selling has gotten really quiet, really unenthusiastic.
This is the point of total exhaustion. The downtrend is basically running out of fuel, because it's running out of sellers. There's just nobody left who wants to sell or has anything left to sell to keep pushing the price down. The panic is over, the market gets quiet.
And this brings us to a really sharp distinction. Uptrends fail because of a buyer's weakness. People run out of money. But downtrends end because of a seller's weakness. People run out of inventory. Think about it. You can only sell what you actually own. It's a simple but absolutely crucial difference in how the market works.
So, what's going on in that quiet, low-volume, weak downtrend phase when it seems like everyone else has lost interest? Well, this is where the smart money gets to work. This is the secret to how the next big trend is born.
I love this quote because it's so true. The really big players, the institutions, they don't wait for a trend to be obvious and then try to jump on. That's way too late, way too expensive. No, they position themselves to create the trend from the very beginning.
And they do this through a process called accumulation. So during that quiet, boring, low-volume, weak downtrend, when sellers are exhausted and prices are cheap, these big players are quietly, secretly, buying up massive positions. They soak up all the available shares before anyone else even has a clue, setting the stage for the next big move.
Okay, let's put all these pieces together. Let's see how all 4 of these phases form one continuous, repeating cycle. This is the natural life cycle of pretty much any market trend.
So here it is, all laid out. You've got the healthy uptrend, price up, volume up. That's strong conviction. Then the weak uptrend, price up, but volume down. The buyers are getting tired. That leads to the healthy downtrend, price down, volume up. That's aggressive, panicked selling. And finally, the weak downtrend, price down, volume down. The sellers are all tapped out. It's the whole story right there.
And here's how it all connects in a loop. It all starts with that quiet accumulation during a weak downtrend. That builds the fuel for a brand new, healthy uptrend. Eventually, that trend matures into a weak uptrend as buyers run out of steam. That exhaustion then leads to a healthy downtrend as everyone rushes to sell. And finally, that selling dies down into a weak downtrend, which, of course, creates the perfect quiet environment for the next cycle of accumulation to begin all over again. See how it works?
And that really brings us to the final takeaway. So I'll just leave you with this question. The next time you look at a chart, are you just going to see the price, or are you going to be watching the crowd? Ask yourself, are they pouring into the stadium, or are they all heading for the exits? Because a lot of the time, the crowd knows the real story long before the price does. Thanks for tuning in.